Hey everyone, this week we're going to talk a little bit about what's happening with interest rates. There's a lot more uncertainty in the market right now, and this is really tied to what's happening with trade with China, and it's weighing on the stock market, causing investors to move money into bonds. That's driving down the long-term bond rates, and the 10-year Treasury is now down a full percentage point from last October. It's down into the low 2% range, roughly on par with where it was in 2017. Short-term bonds, like the 3-month Treasury, are heavily influenced by banks and the Federal Reserve. There's been a lot of upward pressure on these for the last 2 years as the Fed started pushing up interest rates. The 3-month Treasury is now around 2.35%. That's more than 10 basis points higher than the 10-year Treasury right now. That's a yield curve inversion. So an inverted yield curve, which is where short-term rates rise above the long-term rates, is a commonly identified indicator of an upcoming recession. Now, strictly speaking, the economic study on the topic focused on when the yield curve inverted for at least a full quarter, which was a signal for a recession. So we're not there yet, but the correlation when we do hit that point is usually a lead time of 12 to 24 months. Setting aside what's happening with yield curve inversions, you look at the primary drivers of commercial real estate space demand, and they're all still very positive. We have good job creation, household formation is pushing record levels, retail sales are up, corporate investments into infrastructure, they're all positive, and that's driving real estate space demand. Falling interest rates do offer investors stronger positive leverage. The 10-year Treasury is back on par with where it was in 2017. That gives investors more maneuvering room when it comes to their lending and financing on properties. Cap rates, for the most part, have been pretty stable for the last 2 years on a macro basis, so the yield spread has opened back up. Looking forward, investors should evaluate their portfolios. Consider long-term drivers and extended portfolio performance, as well as market and property type diversification. For example, right now retail and office properties, particularly in suburban areas with high walkability, will benefit as the millennials age into their 30s. Also, secondary and tertiary markets are outperforming right now from an economic standpoint, particularly across the Southeast and Southwest. This is because companies are looking for new staff in new markets because the unemployment rate is so low. So, although the yield curve inversion could imply some recessionary risk in the next couple years, a recession is not a foregone conclusion. If a recession is in the card, there's still likely significant lead time, so investors can position their portfolios appropriately. Most economists anticipate that the next recession will be mild, especially in contrast to the last one. In the meantime, a window of opportunity has emerged with interest rates coming back down into alignment with where they were a couple years ago, and investors can capitalize on the positive yield spread.